The World Bank has issued a warning that global growth in 2024 is anticipated to decline for the third consecutive year. This trend is expected to exacerbate poverty and increase debt levels in many developing countries. The first half of the 2020s has been impeded by the COVID-19 pandemic, followed by the war in Ukraine, and surges in inflation and interest rates globally. The scenario is now projected to be the least robust half-decade performance in 3 decades. According to the latest report on global economic prospects by the World Bank, global GDP is expected to grow by 2.4% this year, compared to 6.2% in 2021, 3.0% in 2022, and 2.6% in 2023. Consequently, growth in the years 2020 to 2024 is expected to be weaker than during the 2008 to 2009 global financial crisis, the late 1990s Asian financial crisis, and the early 2000s downturns. Ayhan Koza, the deputy chief economist of the World Bank, revealed that growth this year, excluding the pandemic contraction of 2020, is estimated to be the weakest since the global financial crisis of 2009. The development lender has projected global growth slightly higher in 2025 at 2.7%, which is lower than the June forecast of 3.0% due to expected slowdowns among advanced economies. It appears that the World Bank's objective of eradicating extreme poverty by 2030 is now mostly unattainable due to geopolitical conflicts hindering economic activity. Indamit Gill, the chief economist of the World Bank Group, stated that near-term growth will remain weak, leaving many developing countries, especially the poorest, stuck in a trap, with paralyzing levels of debt and tenuous access to food for nearly 1 out of every 3 people. The World Bank has recommended accelerating the annual investment of $2.4 trillion required to shift towards clean energy and climate change adaptation to boost economic growth, particularly in emerging and developing countries. Comprehensive reforms, including structural reforms to expand cross-border trade and financial flows, as well as improvements in fiscal and monetary policy frameworks, are required to achieve such accelerations.